Sorry, there we go. We were discussing where we are, which is quite pertinent because seeing as one of the things that was discussed in the videos was sort of news assimilation and how do you work out what you want to do next. This is one of these days where you can do all the prep you want, but a bit of news comes out early on and that sort of sets the tone for the day. And this becomes very much a kind of flow driven type of day. I've got all of the sort of key bits of news that have come out so far today up on the board. So we'll go and have a look at a bit of those. And then where can you actually get to now? For me, one of the things that I always try and stay away from is the temptation, whether you've got involved or not so far, the temptation to go, well, that's gone a long way, surely it'll bounce now. And if this story escalates and escalates, and even without escalating, there's the building up of the potential for that, you could end up with a market that just rolls over. I'm talking equities at the minute, that just continue to sort of roll over. That's what you don't want to get caught going, well, it's going to bounce in a minute. You'll get some bounces, don't get me wrong, just in the S&P's just pinged off the lows by about, 10 handles in a couple of minutes. So you will get some quite quick bounces in this, but don't assume that that necessarily is a reversal. See it as a bounce. And that's the way that I try and look at these. Just to try and keep yourself away from getting trapped into an idea that, at the end of the day could be very, very dangerous. If this is going to reverse, if you get some kind of de-escalation of the story, wonderful, because now you've got real easy targets all the way back up the move that we've had so far. If you I don't see why this suddenly reverses, why everyone suddenly thinks, oh, well, it's not a problem. Anyway, on to the news. So there's a couple of bits. The real big reaction was at 9:20. So I've got all the sort of timestamps on these. The first one was at 8:35. This was reports that Ukraine may use a weapon and they're monitoring the situation. This is coming from Russia. And then any aggression against Russia by a non-nuclear state with participation of a nuclear state will be considered a joint attack, says this is a very important point. The implication of that is if Ukraine uses a US weapon against Russia, they would consider it a joint attack, which theoretically I would take to mean, and I think most people took this to mean, Russia could then attack America. So that's pretty significant, and it's always taken measures to minimize nuclear threat, and nuclear weapons are a means of deterrence. I wasn't around in the Cold War, but anyone who may know much about that perhaps would know a little bit more about the way that these things then pan out and the rhetoric between countries and the escalation of that rhetoric. Probably worth going and finding a bit out about that. Go and do some reading about the Cold War at the moment, just in case that's where we go. Obviously, that's a long way down the line, but if you're going to do some reading about something, you might as well do something constructive and prep yourself in case we go there, rather than just trying to react day to day off the data. Go and see what markets did at that time as well throughout the Cold War and how markets start to react to it. I think it was the 60s, right? That was quite a significant. Yeah. Russia's position is that nuclear war will not happen. So there you go. If you want anything pretty clear. Who said that? Lavrov. So there you go. That's the just come from Reuters. Here you go. Yeah. So that's.
And then he says in his next comment, "I might be wrong."
Yeah. However. But yes, interesting. Not going to accuse the Russians or conspiracy theory this too much, but interesting the depth of the selling in equity markets about 15 minutes ago. Very nice buy if you're ready to put that post out. But yeah, most people have gone across the board as it's a buy equities on that dip. Basically, that's the main trade for most people on that. Sorry. That's not quite such a de-escalation. We won't go to war with it, but we're still going to threaten you with it, which I guess is the essence of the Cold War, right? That nobody really wanted to do it, but everyone knew that the other one could do it, and it was that kind of game. But I think definitely something to well, you now got a bit of action on this, a bit of opportunity. So there you go.
Any possibility that the US would use one, or if anything, it's going to come from Russia?
I'm not even going to bother speculating on it, to be honest. I have no idea. If I knew that kind of thing, I'd probably be working for the intelligence agencies, not doing this. I have no idea, to be honest. Essentially, all of this type of thing is assumed to be an action to deter the idea of anyone actually using it, the concept of mutually assured destruction. Whether anybody would, you would assume that the only person who's likely to actually use a nuclear weapon is someone who's a little bit on the crazy side as opposed to entirely rational. I'll leave you up to your opinions on people's rationality. I would put Trump in the far more rational camp than Putin, personally. But yeah, that's the kind of level of subjective speculation that you've got no idea what the answer to that is. But what you are seeing, very quick reversal. Euro stocks, and I'll go through some of the charts in a minute, because what you do need to do, and what I was going to intend to do before we suddenly got some action on this, was discuss, well, where do you go with this? What markets do you trade? How do you approach this going forward? Euro stocks has been one of the more significant movers on this. So I'll just get those out of the way. The main reason for that, of course, it's the closest very tradable equity market to Russia. So it's much more directly linked than, say, the S&P is. The S&P's obviously got a lot of other stuff going on in it as well. You know, you've got the whole situation with, you know, the election and what goes on from there, etc., etc. So, you know, there's a lot more moving parts to the S&P, whereas Eurostock's a little bit more straightforward in terms of its reaction to this. There's pretty decent performances on it. A good day for a fair few people. Good times. Right. We'll come back to what's been going on. So they've taken measures to minimise nuclear threat. They viewed it as a deterrence. It's interesting, that's exactly what Lavrov just said, that it is a deterrence and it's an extreme measure. So they are essentially repeating themselves. It's coming from Lavrov, who's a pretty big deal. He's Russia's, is it foreign now? He used to be energy minister, now he's foreign secretary. He's a pretty big deal. You know, next in line to Putin, he's the next big one. But essentially it's reasonably repetitive. So that's Russia's position. Then you get Ukraine actually fires one of the weapons into Russia. So now we've got the situation where they've actually done it. What comes next? That got a bigger reaction than this. Yeah, at the end of the day, this is, as much as it sounds quite aggressive and quite significant, it is only restating a position that Russia already has. The fact that they've gone and restated it still is reasonably significant. And then we've had this one a minute ago. Putin's issued his warnings already. Right, so that he's suggesting that Ukraine does seek escalation. That was the other aspect of it. He definitely seems to be more hawkish on war than Putin, Lavrov. He's pretty keen on it, it seems to me. And then he's quite positive on Europe in that sense, at least. So there's an element of sort of reconciliatoriness about it all. Going back to the whole, how do you sort of factor all of this information in? What do you do with it all? And how do you sort of manage that? Then this is a case of, excuse me. This is then a case of, back to as I put it, what's your assumption? Well, I think this is a pretty straightforward assumption of risk off. Sell equities, buy bonds, buy gold. The really, really obvious place, or well, in hindsight, when you go and look at the charts, the really clear place and a market to watch is Euro Yen. That's the one that really reacted on it, because people run to the yen and they go away from the euro, because you don't want to be in Europe if this escalates. You know, whilst it might be an American sponsored idea, if you were, ultimately the closest place is Europe.
What about oil? Wasn't that
This is the interesting bit, because I would have said, yeah, oil as well. Oil's reaction was pretty limited. So what I'd be doing, if you traded it, obviously you know what happened and you saw it. Even if you didn't, get your charts up. You want to go and look at what was the best initial reaction and what was the most sustained reaction, so that you then know where you want to go on any future commentary on this. You don't want to go wasting your time in markets that you think should have done something and actually they didn't do anything. Go and work out where best to go and follow that. Also, think about the implications. How sensitive are markets to this? What are you going to trade in future? what is ultimately the implication of all of this? That's where you want to be going. Dead simple. Get up the markets that you think will have moved. Get a 1 minute chart of all of them. That's oil. I think if that tells you one thing, it is don't bother trading oil on this. It barely reacted. That was the initial, no, that was before the initial story. So that's got nothing to do with it. The initial story was this bit of delta and this moved down. Would you have thought oil would have gone down on it? I wouldn't have. So that for me would just be a straight away, just don't even look at it anymore, because even if you think you're right, it doesn't seem to do what you think it's going to do. So you're probably going to do the wrong thing. And there's no way I'd trust doing the opposite in this situation. If it escalates further, I'm still not going to sell oil on it, but now I don't trust it'll go up either. So forget that. Stay away from oil. That seems like a dangerous place to be.
Even it was the other day or Friday, I wasn't reacting to comments either, so that could have been like a
Yeah, so I think that tells you the whole, it tells you everything you need to know. It's not the place to be. Just stay away from it. You don't never want to be trading a market that isn't reacting how you expect, because you're never going to trust the move. You can get on whatever you want and you won't believe in it because you see there, it doesn't do it. And the second comment, that's the highlight there, that has a little jump of about 10 ticks, which again, I think probably tells you everything you need to know. You just don't want to be there. So leave that one alone. The other place you want to be looking is equity markets. It will be the first. Equity is usually, for me, the first place to go. Sentiment is always my view on these types of things. It's bad, sell equities. It's the straightforward reaction. The S&P on the big one, the Ukraine firing the weapons, it took its time. So that's the other thing to look at. The S&P sat there for 3 minutes and did nothing. Euro stocks, if you sold it, went down. So again, when you start thinking about choices, Euro stocks becomes a better choice in this one. On that initial move, it's not so dramatic. That's the only thing with Euro stocks, but you can hit a hell of a lot more size. Euro stocks is 300, 500 lots on the book. The S&P's double digits now. So you can hit 10 times the size in Euro stocks. Yes, it won't move quite as far, but I prefer something that you can hit it and it goes tick, tick, tick on side and you think, yes, we're all good here, than a market that 3 minutes later is still just going up and down, up and down, up and down around you. You're never going to get a great entry on the S&P because it's that little bit quicker. So it's going to whiz down. It's not quicker, sorry, it's going to cover more ticks. So you're never going to get in at the top. So if it doesn't go straight away, it's just going to keep coming back to you and going offside. After 3 minutes, I think you're going to struggle with that. I was speaking to one of the guys when I came in and he was like, he missed it. And he said, it's one of those, and I know exactly what he means. Everyone does this. You look at that and go, if only I was here, I would have absolutely cleaned up on that. You would have got full size short at the top and you would have got out there. That's what you think in your head. In reality, 3 minutes of watching it go in a 4 tick range, you're not staying in that. Most people will give that up. Incidentally, hardly anybody's made any money in S&P today. Partly that very, very few people have traded it. Most people have gone Euro stocks or Bund as the main markets today. Stocks has gone. It's worth having a go at trading Euro stocks at the moment. If you've never traded stocks, this is the time to go and have an experiment with it. Stocks is not the most enjoyable market most of the time. It's pretty slow, it's pretty steady, it's pretty dull. When it gets moving, it's good. It has flow, it gets moving, it trucks along. So it's really good in that sense. That move there is the best part of 45 ticks, which in Euro stocks is tons. So that is a decent move. And that's exactly it. That's what's good about it. When it's got some reason to go, it goes and it gets on with it and it doesn't do this wash back and any messing around. It's just tick, 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 tick. It's relentless. Really, really good. If you get something right in stocks, it just goes. Gold's moved, not in the nicest of ways either. It's done a little jump and then struggles and tick, tick, ticks along. What I thought was quite interesting was, and I'm not entirely sure this was all to do with the comments, because the initial story in the yen comes out here, which is around here on your chart. And then you've got loads of volume that comes after that. The only thing I put that down to is that this has perhaps hit some stops. You've triggered some stops and that's then kicked the volumes up rather than anything else, because that seems exceptional and doesn't match anything else. So that would be the other thing on that. The euro went on both. That was the first bit, that was the second. So you also look at that and think, actually, euro looks quite attractive now. That becomes, of the two markets so far that we've looked at, I'd be looking at stocks and euro on this. Treasuries or Bund have both gone quite nicely on it, so I think you could pick either of those. Bund would seem more logical. just because it's closer. At some point, the more and more this escalates though, you'd go Bund, actually leave it alone and go T-note, because you'll start getting the wrong reaction in Bunds, and they'll start to go up and then reverse because, well, you don't want to own German bonds if they're going to get dragged into it. So you could start to get to a point where the bonds start to lose their sort of significance, and then it would be Euro stocks and Euro dollar, I think. S&P's still a choice. That'd be the main way I'd go. Gold, I'm not convinced on gold there. I don't think it's actually the nicest of moves. It looks a pretty ugly, choppy move. So that's the whole point of doing this. You just go quick over everything and go, well, where do I want to be on the next instance or the next bit of the story? Euro stocks. The other part of it is Euro's already pretty weak anyway. It seems very keen to just go down, down, down. So Euro becomes quite attractive. This is the bit of where you then look at it in a wider context. Stocks has been weak since the election because of the probability of tariffs. So you've got a weakness in stocks. You've got a weakness in Euro since the election. Bonds don't seem that strong. And so that's another thing to factor in. Whilst this is bond positive, there's an element of bonds don't necessarily want to go up. So unless this really keeps them going, they're the ones that probably have a little bit more fall over in them.
Richard, how do you balance with the bonds?
Yeah.
The flight to safety, yes, which is what's driving price up, right? Because people want them.
Yeah.
But also the implication, well, if there is contagion from Russia into the economy, then presumably that's going to be either more inflation or markets perceiving higher potential for higher inflation, less growth, and therefore less probability of higher interest rates, which would send the yields down and prices up. Is that how? Well,
this is where it gets difficult with the bonds, because the longer implication of this is you could end up with higher inflation, which you don't really want to raise rates at this point in time, but it then takes away any justification for a rate cut. Also, if this does escalate further, you run the possibility of more spending being needed, possibly to fund a war in the real extreme, bond issuance. So then you'd end up with a greater supply of bonds, bond prices will fall. So bonds initially are straightforward. The longer this goes on and the more escalation in it, I think the trickier bonds get. And then I think it becomes a little bit more straightforward, go to equities. Because if they're borrowing more money, it's bad. If there's more inflation, it's bad. If it escalates, it's bad. Are you really struggling to find anything good? You can always bring out the age-old, well, war brings innovation, which is good. Great for defense companies, but they're not the big companies in the world at the moment. So yes, BAE Systems will do rather well out of it, and it's a big one, Northrop Grumman in America. They'll do great. That's the main one I was thinking of. They'll do great out of it, but that's not going to turn around the impact it has on everyone else. Yeah, again, if you're going really down the line, maybe tech companies do well out of this because, well, they're going to be the ones pushing the technology to help any kind of efforts, all of that side of it. But yeah, that would be my take on it. So yeah, I would, at the moment, bonds would still be a real key choice. They seem to react. They've got some decent movement in them. I'd lean bonds more than T-notes. That I would probably say is mirrored by most people here, is more a personal preference to lean that way, just because most of us have traded bonds to a greater extent than T-notes in the past, so most people just lean that way. And it's European based, so that would be the place to go. So bonds, euro and stocks at the moment, very European centric for once. It's usually much more US based most of the time. Right. I just remembered there was one other question that I had. Sorry, I'll just pull this question up. Add that to the sheet. I completely forgot about this one. Okay. Right, there we go. All sorted. Right, we'll see how this all gets on. Right. Okay. I thought I'd pull this one up because I said, send in any trades that you guys have seen done, etc. And we can cover those. What we're going to do tomorrow, so we'll do morning session tomorrow at 11, and we'll actually do prep for the afternoon session. So we'll do prep predominantly for S&P, but we'll look at any of the US markets. I'll probably do S&P and oil maybe we'll do some treasuries as well. So if people want to go and send their prep in, go for it and get that in, and we can go from there. I saw this one, which I thought was quite an interesting sort of stream of consciousness view on what was going on. It's a good way to kind of think your day through, and this is something that you want to try and build into any kind of routine or anything that you're doing. And a lot of people do this, and literally just write down your thoughts on where you are and what's going next throughout the day. I was always a big fan of just having a sheet of paper. I would just scribble down any thoughts that I got about what's happening next, where the market's going. By doing that, you at least just get your ideas down. One, it helps you when you look back to actually see what you were thinking, rather than retelling yourself the story you'd like to hear about what you were thinking at any point in time. Because everyone would prefer the narrative afterwards, rather than you just got carried away and sold it because someone else in the room said it was a good short and you went, yeah, go on then, click. Yeah, that's the narrative that you don't say that you really thought. You go, oh yeah, well, it's a good idea, but it didn't work, all of that. So you just, at any point, just write down what you think the next bit of the move is. This is a great example. I couldn't tell if it's going to be a neutral or a trend day. Neutral day being because you're opening value, or a trend day because it's had a reasonably narrow overnight. Yeah, I could buy into the reasonably narrow overnight. Every time it hit the top of the range, there was a lot of absorption and the market moved back downwards. Okay, so I'm assuming we're discussing this type of bit, or it's there, either of those. I think you had to look, well, I think this then followed then the stream of consciousness anyway. Every time it hit the top, there was a lot of absorption, market moved back. Day's not over, I'm guessing it's more a neutral day. Right now it looks like a P. I think when this was put up, it was about 7:30, so we'll take it to mean about here. Yeah, I think by that point in the day, you should be reasonably comfortable what the day is likely to be. The ideal is that you should really, an hour after the initial balance has formed, have a pretty confident guess at what the end of the day is likely to turn out to be. So it's worth just looking at it from that point of view and going, well, what do I think is going to happen? You've broken the high of the overnight, you'd run up into this area of light volume. Like I say, within an hour of the IB, you've already gone A, B, C, D, so the D print will have got you to there. So the only bit left was this last little spike in reverse. I think once you got to that point, you're probably thinking along the lines of, you possibly trend, but the fact that it goes up in quite a sort of straight line would get me to think it's unlikely to be a trend. So I wouldn't want to call the high at that point, but I'd also be reasonably confident to say that the overnight high should act as a bit of a support. You've got the previous value area high, you've got the top of the IB. Anywhere down there and between any of those levels, so you've got 12, you've got 16, and then you've got the IB high is 12 as well. So I'd be thinking really 12 to 15, that's your area of support, I would think, for the rest of the day, and assume that we won't go below there, which was my main kind of thinking. So looks like P. I'm not a good trader yet, so I cut my short position too soon. I think I had too much size on. Okay, well, don't view it as because you're not a good trader. View it as, well, this is something to work on. If you've cut your position short, you know what you were aiming for on this. What you want to go and look at is what was it that got you to cut your position short, because that's the thing that you need to try and deal with. If you've got a target and you reach the target, great, get out of the trade, well done. If you didn't have a target, that's probably why you cut it short, because you didn't really know what you were trying to achieve. And if you did have a target and you got out too short of the target, what was it that was the reason that you got out? Was it boredom? Was it just a desire to snatch a profit? What was the cause of that? Because at least if you know those things, you can then look at, well, how do you deal with this? If it's not having a target, well, straightforward there. Give yourself a target. At least then you've got a reference to think, well, how close am I to it? If it's a case of you just get spooked out by what's going on, what I'd do is go back, go and replay it, if nothing else, and ask yourself, well, what is there that's actually giving you a reason to get out? And be clear, when you're in a trade, to get out of the trade, it's got to be really, really, really clear that you're wrong, not it doesn't look like it's going there quickly, it's not how I wanted it to go. Unless it's telling you you're absolutely wrong, don't just get spooked out by the fact it's not gone that quickly or anything like that. I should have entered with micros and let it run. No, I would not see that as a solution. Letting something run is not going to enable you to solve the problem of not staying in a trade for long enough anyway. If you're cutting it short to start with, getting in smaller size and letting it run. All you're doing when you scale down to micros to let something run is basically saying to yourself, it's a small enough position that I don't care if I lose on it. Great, you could sit there and run a micro lot 100 ticks offside and it will only cost you $125. Yep, you might be able to afford that, but think the flip of that. How are you going to make any money with that? You've got to run that 1,000 ticks to make any real money out of it. So yes, you can weather the storm and you can sit through it, and you're sitting through it because it's not painful. You know, I can buy a lottery ticket and know that I'm probably not going to win, but because £2 disappearing out of my pocket is not going to have a great deal of impact on my life, I'll do it. It's a good punt. But if someone said a lottery ticket is £2,000, I definitely am not going to be buying a lottery ticket because the impact is so much more significant. So moving to micros isn't the solution.
Just another thought on that, which is also, if I think of it, would you trade this setup if you had 100 big lots, right? It's a good way to, because that's the aspiration for most people to get to. So if you start to think in that mentality from the start, that will help build judgment around entering good, solid setups with clear understanding of risk and target, as opposed to, which I say this, having done this many times, is jump into the market because I'm reacting to something I see, and I'm wanting the trade to be successful, as opposed to thinking, well, actually, if I was trading 100 lots, would I do the same thing? No. Then in which case, what would I do if I was trading 100 lots and try to follow that from the beginning?
Well,
that
yeah.
builds the right behaviour.
I think it's always a good way of looking at it to say you should be uncomfortable with the loss, because if you're not uncomfortable with the loss, well, you'll sit there and go, it's all right, it doesn't really matter, which means exactly you don't fully care about the trade. It's a good way to increase size as well. If you ever get to a point where you're like, I don't really care what happens with this one, that's because you're not trading enough size. So going down the size isn't going to solve any problems. Sitting with the bigger fluctuations on a bigger contract, particularly on the sim, is a good way to kind of learn that discomfort. Right. And then then a few minutes later, I've got to eat my words, after I posted market reverse, I just got so excited at the repeated absorption. Anyway, thanks to those who saw the post. There's a lot. There's a lot of stuff. Yeah. Well, I can't remember who put this up, but well done for doing it. Well done for being honest about it all. Key to that, I think, comes down to, it seems like you've seen some absorption wherever it was up here. You've got excited about it, got into the trade, great, wonderful entry. And for me, I think it strikes me as one of these where you weren't entirely sure what you were going to do with it, which comes back to, you've been going through what you think's going on. Possibly a balance day, possibly a trend day. I think once you've seen it do this, it's definitely not a trend. It's not really a neutral day, but it's done the sort of P, which gets referenced here. So if it's a P-shaped day, how much further are you really looking for this to go? And I think that all comes back down to this part, that the hype around the trade and the excitement around the trade is what's caused the problem, because I'm going to guess that when you wrote, I got out too short, or I cut it short, probably here, which is absolutely bang on. The problem with that is because you didn't know where you were going with it, it feels like you cut it short. In fact, I think you've got to look at that and think you absolutely nailed that, be pleased with it. But what's probably happened is you've got out and then you've got that sort of regret of, oh no, but it might go so much further. Don't worry about it. And that's why you have a target. If you've got a target, you get out and you're happy with that, job done, move on, go and find the next trade. Be pleased with those extra pounds in your pocket. But good to see that sort of, writing your way through the day. It's really helpful. Okay, I've got a question on firms that offer option flow data, spot gamma, cheddar flow. I've never heard of cheddar flow. I'm not going to trust anything named after a cheese when it's related to finance, personally.
Cheddar balls, wherever that is.
Yeah, exactly. We're there. Anyway, I'll be honest, no, I haven't followed them. I know that a lot of people talk about it. I actually asked one of the guys about it. One of the traders has got a big spreadsheet that works them out for himself anyway, so you don't have to subscribe to it. I'm not sure the exact workings of the spreadsheet, and it's not mine, so there's no way I'm going to share that with anybody. Ask ChatGPT, which I did, and it explains to you how you can work these things out. So do that, create your own spreadsheet, work them out. Therefore, you don't need to pay a subscription to Spot Gamma. Anyway, what you're predominantly looking for is where the greatest amount of open interest is on certain levels. This uses all of the one-day expiry options as well. That's what a lot of it's focused on. Anyway, what I discovered from speaking to my mate upstairs is 59.40 and 58.90 are your two sort of biggest near to where we are trading levels. At least this was when I asked, and it was trading somewhere around here. So you were already through the biggest open interest negative gamma level. The main thing that he suggested is, one, this is significant during option expiry week and not massively significant afterwards. The other thing they suggested was the idea that when you move from the positive side of neutral, so you're on the positive side and you move through neutral, that's usually where you can get a pickup in momentum. These typically act as resistances. Didn't say much about negative ones acting as support necessarily, but that typically is a resistance. And then when you come from the positive side and go through neutral, you typically get acceleration. Like I say, I don't have loads of opinion. I think the most straightforward, simple way of dealing with this is go and work them out, or find out how to do it, ChatGPT. Go and work it out, and then go and see what happens. You know, just plot them on every day. You go and stick the levels on and go and see if there's anything to be done around them. That would be the simple way that I go about doing it. Yeah, what you can see today is it never went there, and it went straight through that one. So I'm not drawing too many conclusions from that, apart from what you got to ask yourself, what are you going to do with them, and how are you going to trade around them?
What's the significance, and I suppose the question to ask is, what does that level mean to the other market participants and their potential actions at that level, right?
Well,
if that's what you're marking the level for, is it in anticipation of a response to market participants to drive some form of price response?
Yeah, it's to do with hedging of option positions. So I'm not massively knowledgeable about options, so go and ask ChatGPT. I looked a few of the bits up, right? So when options are at the money, so you're near the strike price, the change in the price of the underlying assets, S&P futures or whatever it is, has a greater impact on the price of the option itself. That's what's referred to as delta. So the way that you deal with that is by buying or selling the underlying. The gamma is then the second derivative of that, which is the rate of change of delta. So it's the acceleration of delta. Once you go back past certain points, or the sort of big open interest gamma strikes, the idea then is the rate of change of delta will accelerate. So then the faster it moves, and so it perpetuates.
Which means it's going to drive more participants to buy or sell the underlying,
yeah.
Which is going to drive the...
And as they do that, it pushes the delta, which accelerates the delta accelerates, which is the gamma aspect of it. And so the whole idea, and that's where the whole momentum idea comes from in it, that once you go past certain points, you can pick up momentum. Alternatively, the other way to deal with them is to prevent them going through those levels. And if you prevent them going through, then you don't have to hedge. So that's the counter idea to it. So they kind of act as a sort of, if you will, you see it as a wall, or I guess you see it as a dam. It will either hold and nothing will go through it, or it will break.
Points above a big figure and stuff like that, you'll see defence or...
Yeah. And then once that breaks, then you'll get the sort of washout when it goes through it. So I think I'd kind of try and view them like that. But again, that's where you've then got to work a strategy around that you want to be able to go, well, each time you get to one of these points, I'm going to do X or Y. Rather than, I don't think it's as straightforward as you can just buy or sell them whenever they go there. I think you've got to have a bit of a plan as to also how they relate to where you are on the day, because then you can take it from there and go, okay, well, if we're here on a day and you go past that point, I'm looking for momentum and it's gone past that point. Maybe it's more significant, and like I say as well, see if they're more significant on certain weeks. Option expiry week seems to be the big one, because not only do you have the 1 day options, you've then got the monthlies, and then you would also have quarterlies and weeklies. So you get a lot more sort of activity around those. They probably have a great deal more sensitivity. So there you go, something to go and look at. But 59.10 seemed to have a little bit more action on it. That was the first drop down. So 59.10 was the neutral point. We whipped through it on the first comment and then accelerated through it on the next. It's hard to say whether that's got too much to do with the neutral level or more to do with the fact that you had some pretty significant news. So irrespective of levels, it was almost probably one who was going through there anyway, is the other way to try and think about it. So there's always other factors on these types of things. Right, ignore this chart, by the way. that was scrolled back. So we're not down at 57.35. We are sort of 58.80-ish was the low. 58.80 was the low. Right. This is a question. During the evaluation of a possible trading strategy, what would you consider a good sample size before deciding whether it's worth pursuing further and demo trade it as an actual trade setup? So, sorry, I put this up. It's not really that relevant to that. So this, the bit of sort of evaluating a trade, working out whether you think it's actually worth using. I always think that's a really difficult thing. You can build up a huge amount of data on anything and go, okay, well, that's enough now. So yeah, that'll do. And I can take this. I think this, the main thing I would say as well, don't work something out and then demo trade it to start with. You know, what I call sort of forward testing an idea. If you see something today and you see the similar type situation tomorrow, trade it as if it's the same thing as yesterday. This way you build confidence in the idea of what you're seeing rather than have to have a huge amount of data to prove a point to you. What humans are very good at is being able to infer a sort of implication going forward far better than the necessity to prove something to yourself. You know, if something happens today, say this Russia-Ukraine situation, you don't need lots of past data of comments to be able to go, one, I've seen what's happened today, therefore, if we have any further story along this line, I know what to do. If you wait until you've got enough evidence to tell you what to do, the story's over. It's what humans are very, very good at. That you don't need lots and lots of evidence of something to go, well, that's probably the case. So I would just start real simple. If you see something one day and you think, yep, I can understand what happened here, and then it created this move. If you see that again, trade it. And trade it as if that is back tested and you know what's going to happen. Because you'll find out very quickly whether it does or doesn't work. And that, I think, is far better evidence of something than being able to sort of run it back through various different sort of tests over time. The other factor there, or the other thing to consider, is markets don't stay the same. So the game changes over time. So as you move through different types of environments, we've gone very, very quickly in the last 2 weeks to a completely news-driven environment from where we were 3-4 weeks ago. It was actually quite technical. It wasn't particularly narrative related. Now it is very news related, much more sort of geopolitically influenced than it is economic data influenced as well. So all of these things change really, really quickly. The size of moves that you're getting in the S&P at the moment, far bigger than they were 3 weeks ago, because you've had that bigger shake-up of action. The elections helped, and then this story's added to the picture as well. So yeah, I would say a good sample size is 2, ultimately. I know that sounds really, not what most people would expect to hear, but I think with anything you see, I'm also a big believer in a lot of times in trading, things happen in little patterns over a sequence of days, partly because perhaps somebody's got some business to do. They come in one day, they get it done. They come in the next day and do a bit more of it. The next day, they do a bit more of it. And you can have these patterns where you see a sort of little type of pattern that plays out, or a little bit of order flow that plays out, and you'll see the exact same thing at a very similar time the next day. You can't always see it and you can't guarantee it, but your job is to go, well, I saw that, it happened at this time, it looked like this and it did this, let's go and look for it tomorrow. Because if it looks like it's doing it tomorrow, well, believe it will, rather than assume it's wrong. Assume it's right and then wait until you're proven wrong. The other reason for doing that is you don't know when the end of a pattern's going to come. So one of the things that someone said this to me the other day, I can't remember who it was, and I thought that's just a really bad idea. It's something about trying to predict the end of something happening, and my view on that is, well, you don't know. If you've seen something in the order flow today, that might happen for the next 10 days in a row. It might only happen for the next 3. If you assume that this will just go on and on and on and on, you'll lose on one of those. That's fine. There's no problem with that, because if you trade it every day and you make money, and then lose, well, now you know that that's the end of the game and you stop doing it. If you try and predict the end of it, what you do is you trade it for a little while and then you go, no, I don't think there's going to be anything more in this. And you watch all of the rest of the move happen and think, why didn't I keep on trading that? People don't like losing, I know that, but you're far better off to lose once when you're already up here to indicate it's the end than you are to stop doing something here and go, wow, it probably won't keep happening. Because what will probably happen is it keeps happening, it happens enough extra times, you think, well, I've got to do it now, and you get back in and start playing the game again up here. Key thing is just to recognize when it changes. If you spot the change, give it up. Assume that it now isn't a strategy, but you've got it in your back pocket, because it will come back. Everything does. You always see these things come round and round. So that's how I try and do that. I wouldn't test something and create a big spreadsheet of it before even trying to trade it on a sim. I think just if you can get a chart of it, of what happens, and roughly sort of be able to go, right, well, this is the identification, the sort of preamble to the trade. This is what I want to see. Execute. That's it. I think you just go with that, and every time you see it, you keep on doing it. Over time, you'll start to get a sense as to whether it works or it doesn't. You know, there's some trades, and you know, I've done this like creating playbook type ideas that I put something in and gone, oh, I'm going to look for that again, and you just never see it again. That's fine. But if you do see it again, you've already got the first bits of it, and now you've got more examples, more evidence of it. You become confident in that as a trade. Right. And slightly more sort of going on a debriefing type of question on this one. Are there methods you can suggest for breaking common newbie bad habits? What are the top 3 bad habits you want to avoid in your opinion? I'll give you my sort of view on that, or at least things I can initially think of. I put one bad habit, maybe getting shaken out of trades and closing before targets on small pullbacks. Solution, maybe press a stop on a target and leave it until one or the other is reached. I'll explain to you what I would do with that. One of the things that I did earlier very quickly for you is there's a trader who's very good at it, writes sort of comments about every single trade and shares them with me. So I'm not obviously going to tell you who it is. What I did, it's become my new favorite thing, copied all the comments into ChatGPT and said, can you give me the top 3 things that this trader feels like he makes a mistake on? The good reason for doing this is this is your own words. This is you who's written these things. So ChatGPT just takes that and tells you what your own problems are. So it's not you assuming problems or trying to work out what it is that affects you and, you know, leaning on what you kind of would like it to be, or, well, no one wants any problems, but if you've got a problem with doing certain things or you get shaken out of trades in a certain way, you're better off to know what those things are. So yeah, I literally just asked it what are his top 3, I can't remember the exact wording I used, but basically asked it what are the top 3 things that this trader gets frustrated about, and that's what it gave me. Missed opportunities, failure to adapt to changes, and emotional trading. So there you go. And the whole point of doing it on ChatGPT, like I said, is it holds a mirror up to you, because this is exactly what you wrote. So it's then just feeding back what you wrote and what you think the problem is, and mistakes that you're making. So that would be one thing to do. Just any of the trades that you do, just write a quick commentary. This has been done, he does it in Excel. So it's literally entry, exit, reason for trade, what market, what was the trade idea, comment, writes down a little bit on it, and then you can then scan through all of that and go, right, well, what was it? And I'm sure you can escalate this into what's common about winning trades versus losing trades, from the comments on these types of things. You can go a million miles down the road with all of this type of stuff. But if you just want to know what the things are that affect you, go and do that, because at least then it makes it easier, and you don't have to worry about, just write whatever you want. Stream of consciousness type idea, like was put up earlier, you'll get a good sense of it. On this one, getting shaken out of trades on pullbacks, solution I've always suggested to people, I'm going to assume, let's say that you trade a 2-lot. You trade a 2-lot, you get shaken out. What I would do is add a contract when you enter a trade. Add a contract, and with this contract, put an OCO in, a stop and a target, and leave it. It's going to one or the other. Do not touch it. Whatever happens, just leave it. The other 2, you can then trade like you normally do. Do whatever you want. Because what this will hopefully do over time is effectively prove to you whether your idea is good or bad. If you get out of trades too quickly, this one will often come back and lose. So you'll actually impact your performance over time, because actually you're not getting out of trades too quickly. You're doing the right thing. If a lot of your ideas do run to the target that you set, well, this one will always get there and it will add to your performance. In which case, it's a hard argument to not then flip this over and go, well, I can mess around with 1 lot, but 2 of them are going to target. Or a better way to do it is increase your size to 4 and do it 2 plus 2. That would be the way I'd do it. Do it 2 plus 2 and then do it 2 plus 3. The reason for keeping the initial 2 that you get out too quickly or you reduce your risk or any of those types of things is sometimes there's a bit of upside to that. If that gives you a slight feeling of comfort in a trade, it's detrimental when you're trading 3 and 1 and running 1 to target. But when you're trading 2 and 10, that has reasonably limited impact on the overall trade. But if those 2 lots just getting something out makes you feel that little bit more comfortable, you'll carry all 10 to target. So yes, it's not optimal, but it's quite hard to trade in a perfectly optimal way. You become robotic and no one is. So you're better off to kind of keep those and deal with it like that. So that would be a suggestion for doing that. Increase the size. If you don't want to increase the size, go micros and do it that way. So pop it up on micros, add some contracts on micros, and try and sort of think of it as essentially 2 aspects of the trade. One is a getting in flow, you're going to be impacted by what goes on within the market, and the other one is pure technical, and it goes or it doesn't. You'll sort of teach yourself to stick to a trade by doing that.
Like you said before, it's like if you abstract the value of micros versus the big contract and just trade the number of contracts in your head, you trade 10 contracts, not 10 micros or 10 big, you just trade 10 contracts.
Yeah.
And then therefore you can take that 10 micros to large ones, because when you do take the mentality of trading 10 lots, regardless of the size, it could be micros, it could be the old big S&P.
They're big ones, yeah. Yeah, precisely. That's one of the big things I think is good about micros. You can get into, if you've got a double-digit position, you've got a 10 lot, like you say, it doesn't matter what market that's in, it feels big. And if you've never seen a 10 lot before, the first time you put a 10 lot on with real money, that feels big. And it's, as much as it's only 1 more than 9, it's a hurdle. It feels a bigger deal. If you've already seen it on micros, it doesn't really matter so much. What I would suggest people if they're starting micros is your goal should be, if you're trading S&P, your goal should be to get to 30 micros. That you can get about 30 micros on most trades. That's probably pushing the limits on how many you can trade before it's really going to impact your ability to execute in the same way. You're going to start getting slipped across prices if you start going much beyond 30 lots anyway, that you won't get full fill or you get part filled on stuff. Once you've got to there, and what I would assume is if you're trading 30, you're doing it in 6 clips of 5 or 5 clips of 6, whichever way around you want to do that. So what I would then do is if you're doing that in 6 clips of 5, I would then just go to 6 big S&Ps. So then it's still 6 clips and you just do 6 clips of 1 and you get the exact same, you double your P&L and double your risk, but you're trading the exact same way by moving up. And it also gives you a good way to jump up. Otherwise it can become one of these things that you can get trapped in the micros by doing that. Don't get me wrong, 30 micros is quite a lot. You can make some decent money with 30 micros, but for those worried about comms, you are going to get crushed on commissions. So yeah, 3 bad habits of new traders. There's so many, so I don't know that, I'm not sure that I've got a top 3. What the worst, I think, is people who have a target and people who stop too quickly. That to me is the worst habit that people have. That they get, I don't know, let's call it $500 up, and they stop. And yes, I can do this. I'm making money, and then they'll lose $1,000 the next day, and then a 500 up, and they lose $1,000. Basically, it's a case of either this idea that you can just bank your money constantly day after day, and that's what's going to make you money, or a fear of it coming back on you. And the people who can't take on risk in the sense go, do you know what, I'm 500 up, I can risk 500 on the next trade and I'm still better off or as well off as I started the day, but I might be $2,000 up for it. People who can't take that level of risk are the people that always struggle. They might be able to prove themselves and be able to sort of show that they can perform over a period of time, but something will change. You'll get a day like, today's a bad example because the shake up over the last week, but you would have had, what happened pre-election. You have the election day, some of the action post-election, and those traders will then just 1,000, down. And before you know it, they've dug themselves a hole that they can't get out of. The problem with that, as I explained, the risk management one, you creep up and drop back, eventually you'll hit a sequence of a couple of big drops, and it will be so many days to recover that statistically you won't be able to do it. People can't run that big enough string of trades together. It's not a bad habit or a mistake. It's it's not a bad habit or a mistake, but something that is a hurdle you have to get over, is probably the best way of putting it for a lot of traders. Is to start with, you don't know loads, so you've got a couple of trade ideas and you do them, and you probably find that you perform a bit. What then happens is you learn new ideas and you learn new trades, and as you do that, what happens is you've got loads and loads and loads more things to do. Within that, there's probably quite a few trades that are not all that great, but it's harder to establish which ones they are. So you'll often see a phase where someone will inch up to start with because they're doing all right. They know their trades, they do their trades. They learn more and more and more trades, and then they start to get much more erratic in performance because they're trading all sorts of stuff that they've now learned. Much of it isn't overly useful. So I don't think that's a bad habit. I think that's more a natural phase of progression. And then you've got to kind of trim down of all of these new ideas and new skills that you have, how many of them are really, really useful, or when should you use them, rather than, oh, I've got all these tools, I'm going to use them all the time type idea.
Richard, just on that, what's your take on that? If you're making that first climb, what's the value of trying to find more opportunities that's going to impact your equity curve? Is that because over time, having more setups in your playbook arsenal will mean you can take advantage of more opportunities? Versus if you're already profitable, why not just increase the size of what you're already doing?
Partly because things change over time, so something that you're doing well now won't continue to work, and so you always have to be, and I think there's also just an organic nature that you naturally become more knowledgeable. So even if you didn't intend on learning something different or knowing something more, you do know more, and so then probably a lot of it is to do with those types of things. You're, well, I understand this and this and this now. You probably haven't really understood it in huge depth, but you understand it enough to know what to do, and they're the ones that create the problems. But I mean, you've always got to be looking at expanding the sort of toolkit, if you will. Otherwise, you end up in a situation where something stops working, and or what you end up doing, and the worst sort of feeling is you're struggling to make money, and now you've got to try and find something that does make money, which leans you towards a situation where you find anything. You're like, that looks like a good idea, and you start jumping onto all sorts of different ideas, many of which are not great, but you're desperate to try and find something to stop the rot, rather than, if you're constantly trying to learn new ideas, you've probably got something in the toolkit for when you hit a tougher patch.
Okay.
That's right. I'm trying to think on the other ones of the top 3 bad habits. One thing I've noticed a lot, actually, and this is something I've emphasised to a few people recently, a lot of emphasis gets put on debriefing, prep and all of that side of it. Really important. You need to go back through trades that you've done. You need to go and actually try and work out where you make your money, what you do well, what you don't do well. That's all really important. But what a lot of people do is they spend so much time creating these wonderful sort of set out, majorly detailed debriefs that they put themselves into I guess you put yourself into a trap of it becoming so detailed and now so important that you can't sustain it ultimately. If it's taking you 2-3 hours to do a debrief, you're trying to do too much. For me, I'll mention this when we get on to debriefing. To start with, I would keep it dead simple. Get a 5-minute chart of the day, get a profile next to it, and just write down all the trades that you took. Nothing more than that. Don't go over the top on doing this. Also, remember the other thing, it doesn't have to be beautiful. You don't have to explain anything to anybody. As long as you understand what the information means and you can gain something from that, that's it. It can be scribbled on a piece of paper. I know Mike does. Mike's got a book and he will draw things that happened and the idea that he had at different points. Now, I'm not going to gain anything from reading that, but it makes a lot of sense to him. And I think people almost try and do too many things, like almost to present the work and the effort, and you don't need to. You just need to get the information down and just think of it like that. Get the information down. The other thing that I don't necessarily think it's a bad habit, but it's a trait that people, or a trap that people fall into, feeling the need to do stuff. So sort of gaining patience is a real key thing that people should try and do. It's very easy when you're new to feel that you're always going to miss something, or you've got to participate in this and that and the other. Otherwise, you're not going to make it. Otherwise, you're going to miss something. You won't make enough money. All of the rest of these types of things. A lot of the time, people get caught up trading very middle of the road ideas because they feel they should do something. You know, they've sat there and done nothing. They feel that there should be something to do. You don't have to do anything. I think it's a really good thing to be able to do is look at a chart, look at a market, and hold your hands up and say, I've got no idea what's going on today. And that's fine. If you've got no idea what's going on, you don't have to trade, you don't need to do anything. At some point you will have an idea what's going on because you will have seen what it's done and how it's reacted and where it's moved, and then you'll have an idea what to do. But you don't need to just get involved straight away. Yeah, even if you've done your prep and then the markets do something completely different, well, that's fine. Leave them to do that and wait for it to come up with something that you know what to do with. So yeah, sorry for not a top three. I'll perhaps try and think of a detailed top three or bad habits, but it's really quite hard to sort of say people have very specific bad habits. But there you go. I think, like I said, shaking out of trades, that's a reasonably straightforward one. You ultimately have to go through a difficult phase, just force yourself to do it. And also the other thing on that, you shouldn't be getting shaken out of a trade on a sim because the money doesn't matter. The money only matters when you get to a point where you want to say to yourself, I am going to take this live, so I want to see if it actually can stand up to a solid daily stop and doing it live. That would be the main bit there. Until that point, don't get shaken out of it on the basis that there's no need to. You know, you're not going to lose anything. No one's going to look at your sim count and go, oh no, this guy's losing money. It's like, well, yeah, they might be losing money, but they're learning and they don't make that mistake. They don't make that mistake again. So actually they're a far better trader. They may not be making any money, but there's a huge number of things that they don't do anymore. That's one of those things. It's not a bad habit and a mistake people often make, chasing markets, getting sucked into, oh, it's just jump, buy it. That's the last time you want to buy something. Something just suddenly jumps, you don't really want to just buy it. Chances are you are the last person buying that. You don't want to be that person. Don't just chase stuff because it's moved, and react to things. Right, probably last one I'll touch on. I used to play blackjack. I didn't. I played blackjack a bit. It's quite fun, I like it. One of the risk management rules is if I lost more than 20% of account, I would recalculate risk. So if it was risking 1% of a 10k account, and then you had 8,000, then you would drop down the risk. Similar to what I call a cliff edge. I like that idea, that you shouldn't change the level of risk constantly. You know, if you have a losing day today, you don't change your size tomorrow, particularly when you're at a point where you're not trading enough size that you can dynamically adjust. So what you end up doing is, let's say you're trading a 2-lot on most trades. If you cut that because you had a bad day yesterday, you've just halved the ability of recovery. That's not what you want to be doing. I think I completely agree with that. Take your account and go, well, until I'm below this point, I'm not changing anything. This applies when you're going up size as well. I put it in the ones that you see people's equity do that when they increase size. I think the best thing to do is go, right, I'm up wherever you think it's time to increase size. That's always the hardest thing, of when to increase size. Like I said before, if you feel really comfortable in trades, that's probably a good time to increase size. Yeah, I'm not suggesting you get yourself to a point where you're panicking every time you put a trade on, but you want to be at a point where that feels a little bit uncomfortable if this trade goes wrong. Up the size and then give yourself a point in your account, whatever that is, and go, until it drops below that, I'm going to learn how to trade more size. It's really, really common. I couldn't tell you a percentage, but I would lean a high side of 50, probably a high side of 70% of people, when they increase their size, the next day they lose money. Often because they get out of the increased size too quickly, and so they still take some losers on the day. The losers are increased in their impact. The winners aren't massively increased in their impact because people just cut down too quickly. Because people fall back to their comfort zone. You've gone from 4 lots to 6 lots. You go tick, tick, tick on sides. You get out of 2, you're back to your 4. You know what you are. You know what you're doing. And also you're like, yeah, but I've just banked 200 quid as well. This is great. But when it goes wrong, you get your 6, it goes tick, 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 and you get stopped out. And that's it's 50% bigger loss. So that's often what happens to start with. You've got to give yourself enough leeway to learn how to deal with that. If you fall back below here, scale the size back down. And when you come back up, you're going to be more comfortable to then ping that size back up. Chances are when you come back, you'll find it much easier to go up because you kind of know that you've already been there. You don't have that discomfort of going, ooh, it's now a 6 lot. I remember getting told by one trader really early on, he was like, just do a 10 lot on your next trade, which I didn't think was the greatest idea. So yeah, this like starting off trading FTSE, trading 1s and 2s. He's like, just do a 10 lot on your next trade. And you always think, well, what's the next trade I'm going to do 10 on? Because you want it to work. I think his whole point was it doesn't matter what trade it is, you want to understand the discomfort of it. But the idea of 5 to 10xing your size up just on any next trade was not that comfortable. So needless to say, I didn't do that.
Particularly where you're, because the skill is the selection quality of the trade opportunity, right? And until your skill level of that is high enough, you've got quite a significantly high probability of losing that on 10 lot because you're not necessarily yet choosing the right opportunity where you've got probability on your side.
Yeah, exactly. I guess the idea being that, well, if you've not really amassed that level of skill, the next trade, if you do it on 10, might just be a winner anyway, which could give you a nice little boost. I've always wondered about the possibility of just starting someone live and going, just go full size payrolls, go for it. You're either getting booted out or you're going to be quite nicely up. They won't learn anything, but they'll be in a position where they can learn if it works and not if it doesn't. It's a big risk for someone to take. Anyway, right. So this relates partly, I think, to some of the things we were talking about anyway. Another question is about max daily risk. Let's say it's 10% or 1,000. So that's a maximum you could lose in a day. How do you split that amount between any single trade you take, keeping in mind we don't know how many trades we'll take on any given day? This is the bit where it comes down to, like I was just saying before, people feeling that they need to do something and taking reasonably middle of the road mediocre trades. What you don't want to do is wind your risk down because you've been taking some absolute rubbish trades and then look at the best trade of the day and go, I've only got $200 worth of risk left. You don't want to put yourself into that situation. I'm not a big fan of the whole idea of apportioning risk evenly. I've seen people do this. They go, right, I've got a $1,000 stop, therefore I've got 4 $250 risks to take, if you will. Theoretically, you're probably not going to lose 4 in a row, so you'll probably get a winner out of that. So you've actually probably got a fair bit more risk than that, which is also something to think about. That people, you often get this kind of mentality where if I lose 3 trades in a row or 4 in a row, I'm stopped out. One would assume, just on balance of probabilities, you won't lose 4 trades in a row. So you've probably got a little bit more than that anyway, is one thing to think about. For me, I think you've got to look at this and you have to have the ability some days to look at a trade and say to yourself, do you know what, this is worth everything. I'll risk my whole day on this one. There's not going to be many of those, but you will sometimes get a situation where you're like, this is absolute bang on. Take that Russia comment this morning. You risk your day on that because the probability of it working is very high. The payout's going to be good. If it goes wrong, I don't think anyone's going to look at that and think that was a really bad idea, because the upside of doing something like that is well worth it. If you absolutely hammered that, you could have been 3-4 grand up. So with $1,000 daily stop, your risk reward on that's huge. It's well worth doing. So I wouldn't say you split it up, because I think, good point, you'd have no idea how many trades you're going to take in a day. There are going to be some days where there's loads and loads of opportunity. On that basis, I would assume that with lots of opportunity, you can find enough trades that are going to make money over lose money. Equally, and this is something as well, just to remember, because I think people often sort of see a stop as a amount they're going to go to, as in, I'll just keep trying and trying and trying until I hit the stop. If there's nothing to be done, going home $200 down because you took a trade, lost, and literally found nothing else to do is fine. You're better off to finish minus 200, having done nothing else, than finish minus 1,000 trying to scratch together money on a day that's never going to make you any money. It's a really bad trait that I see people have. That they go down and they just keep on going down. You think there's nothing going on, and you'll see one person stopped out and almost nobody else has traded. And they've just got into their head that they're going to recover this, and they go hunting trades down. I don't think there is. I think you have to look at this, and I often sort of go on the idea of you have to look at things from the perspective of, am I going to get a better opportunity today? This may not be the greatest thing you've ever seen, but if you don't think you're going to get a better chance at doing anything today, I'd say it's at least worth half your risk, and do it like that. Because if that is the one thing you do, you risk half your day on it, and it turns into a decent, 1500 up day and that's it, that's a pretty decent day. But if you look at something and go, this is probably the best chance I'm going to get, but I've apportioned 200 of risk, yeah, you'll probably still end up, but you're not going to be very far up on that. So I think there has to be an element of being willing to sort of go, you know, this is worth it. That all comes back to the whole idea of expected value on a trade. If you perceive that this has got a really high probability and a really good payout for the amount of risk you're taking, take as much risk as you possibly can. When I say take as much as you can, size. You have to just increase your size. You know, if you've got a 3-tick stop, well, do it with a 10 lot because it's only going to cost you $300. If you've got a 30-tick stop, you might have to rethink that or rethink whether you really want to do that trade. That's the way I try and look at that. So yeah, it's much more a discretionary type of thing. View it like that. So hopefully that's answered that one. Okay, sorry, I just got a message about another message which might be relevant. Okay, I'll respond to that one, Jacob. Okay, last one. Yeah, the last one. Grimey's question was, explain how you use a 5-minute and 1 minute in your morning debrief or morning prep. What I'm using a 5-minute for is, so let's go back, if you will, and look at the S&P from, say, yesterday. Now, obviously, this is what happened yesterday. What I'm looking at on a 5-minute, because you might have your sort of broad idea of where the S&P can go based on what happened yesterday, and that's going to come much more from sort of a for a half hour or hourly chart profile. Yeah, looking at what we did yesterday, we escaped value towards the upside. We stuck value higher. So my first lean would be perhaps more to the upside. Overnight, we've drifted off for obvious reasons. What I'm interested in from a 5-minute chart is the areas where I might want to actually act. So this is then bringing you down onto the details within the day. So for example, this area here, that pullback there, you start coming up to this area, that's going to be a point of perhaps interest. It's not going to be something that I'm like, yes, I must trade that, or that is definitely an area I want to be involved. But if you've got a directional bias, or if you're looking for something, these become the levels that give you a sort of pinpoint accuracy of an entry point, rather than a generalized, yeah, I want to play this to the upside, downside, wherever. That for me would be the point, and it's then validated by this from the overnight as well. Even if I think this is going up, that's going to be a real key point that until we get above here, I don't think this has got any major upside in it. It's got an upside move, but that's it. The other bit I'd be interested in as well is what was going on up here, which from what we heard, there was a lot of absorption, enough to get excited about. So that would then be the area that I would also be looking at. You can go onto a footprint as well. The thing is, if you've seen it yesterday, you know what was going on here. So these just serve as reminders of the price that you remember something happening. That then means that, well, when you go back there, you know what you want to see if this is going to break, you know what you want to see if it's going to hold. So it's just about trying to have a little bit more accuracy. 1 minute, I'm not that fussed about. You know, unless this has been a really, really, really busy day, I'm not going to be going into a 1 minute. But that would be the main sort of bit of it. It's just getting down to those sort of details of where it's stuck, where it accelerated, and the bits that you don't really see when you just look at a profile or an hourly chart. So if you look at that on, say, an hourly, that action yesterday, so this cash session bit, you got one big candle up, pull back into range and hold above it. So I'd be looking at that and knowing that 15.5 has been a major level for ages, I'd be looking at it thinking, well, broadly from an hourly, we keep flicking below here and it won't stay down. Take away what's happened today. If we hadn't had that news, I'd be very much of the view that this can go up today. And then that's where those 25s come in, that because you can see what happened and you see the way it traded and that range around there, then I'm looking 25 and 05 as my reference points, think, okay, well, these are sort of key bits within the day or within all of that area of action. I want to be using 25 as my point to buy from, or my point to play through if I'm looking towards the move towards the downside. So that's how I bring those in. It just adds a little bit extra detail on your day. It allows you to then go and see, well, what was actually going on at 36.5, if anything. If you look on 5 minute, that might be significant, it might not, but for an hourly, you don't see really a great deal in that. So it's just giving that extra layer of accuracy. Right, I will wrap that one up there. 11 o'clock tomorrow, guys, and we'll do prep for US session. So anyone with any ideas, bring them in and we'll go and review all of those for tomorrow. Right, I'm gonna have to shoot off as well. I will see you all tomorrow, 11 o'clock.